Welcome to Dr. Fred Markets. This is not financial advice. The gap between those who understand finance and those who don't is growing every year. Markets, crypto, artificial intelligence, they just require attention. You showed up today. You're on the right side of that gap. Let's make it count. Let's go.
Markets just turned your July 4th hangover into a bond bubble. Signal 1. While everyone watched fireworks and evacuations, GLD, the big gold ETF, ripped over 2% in a day, while the S&P 500 basically flatlined, and Nvidia ate a 1.4% slap. Money dumped frothy AI momentum and crawled into a 5,000-year-old rock. That's not risk on, that's get me paid while I sleep. Signal 2. Under that move sits the most boring monster in finance, the US Treasury market. Yields spent the last year flirting with 16-year highs, and every 401k boomer rediscovered 5% risk-free. But underneath, the real Shark Tank isn't treasuries you buy on your brokerage screen. It's private credit. Non-bank lenders handing out loans at 10 to 15% while you fight over another AI stock at 60x earnings. Signal 3, the same storm system that evacuated real people off the National Mall, has been quietly evacuating banks out of the lending business for years. Post-2008 rules made big banks allergic to risky loans. Who stepped in? Private credit funds, direct lenders, shadow banks with no branches, no app, and no depositors, just your pension, your insurance company, and your safe bond fund shoveling money into 8-12% loans to companies you've never heard of. Here's the cliffhanger. The most aggressive hedge fund cowboys today wear suits that say fixed income team, and they're weaponizing private credit yields while you chase memes. Here's the connection. GLD jumping while the S&P stalls tells you big money wants yield and safety together, not just growth stories. Public bonds topped out at cute 4 to 5% coupons, so institutions went hunting off menu. They built a parallel banking system, private credit funds doing corporate loans, real estate loans, even financing sports teams and celebrity catalog deals, all off exchange, off Twitter, away from your Robinhood screen. Mechanism. Banks get regulated to death after 2008. They still lend, but tighter, slower, more conservative. Entrepreneurs, PE firms, real estate players all still need leverage. Step 2. Private credit funds raise money from pensions, endowments, rich families. They promise steady income, less volatility than stocks, higher yield than bonds. They lend at 9 to 14% with sweeteners, equity warrants, fees, prepayment penalties. They become the house. Step 3. These funds don't mark to market like your stocks. No daily price quotes, just smooth quarterly valuations. On paper, it looks safe and boring. In reality, you've built a high-yield loan machine in the shadows, funded by retirees who think they bought income. Meanwhile, GLD ripping is a symptom.
Does what you just heard make you want to learn more, to dig deeper, to ask better questions? That curiosity is exactly what separates people who understand finance from those who don't. Most people stop at the surface. You're going further. Let's continue.
When real yields look shaky and stocks stall, allocators rebalance. They trim Nvidia after a historic run, they drip into gold as an insurance policy, and they pour even more into private credit because on a spreadsheet, those 10% coupons plug every funding gap. Here's the truth, 99% of YouTube refuses to say. The real bull market is not stocks, not crypto, not AI, it's yield. Anything that throws off cash in a world of fake stability gets worshipped. And while you refresh your brokerage app, private credit has quietly grown into a multi-trillion-dollar monster bigger than high-yield bond markets. It finances roll-ups of boring businesses, plumbing chains, medical clinics, packaging companies, the unsexy stuff that still pays its interest before you pay your Netflix. So what do you actually learn here? 1. When you see gold pop while indices go sideways, read it as income investors are nervous. 2. Private credit is where that nervous money goes when it wants yield without admitting it's taking risk. 3. Your retirement and your safe bond fund are probably already exposed, whether you know it or not. Action, not fear. First, read your own statements. If you own alternative income, direct lending, or private credit funds in a 401k or IRA, understand they're not cash, they're loans. High-yield, opaque, less liquid loans. Second, treat GLD's strength as a dashboard light, not a religion. GLD up plus 2%, while the S&P and Nvidia sag tells you institutions are stress testing their risk. When that happens, growth mania cools and boring income products get bid. You don't chase AI just because CNBC drools. You ask, where is the yield actually going? Third, if you want to study this hunting ground without jumping in blind, track the listed private credit players and business development companies. Watch their dividend yields, watch their default rates, watch what sectors they lend to. Learn how the sausage is made before you eat it. This is not financial advice, but here's the truth. The fireworks in your sky are a distraction. The fireworks in fixed income are real, and they're happening in private credit and gold while you argue about elections and Taylor Swift. Summary: 1. GLD's jump versus flat stocks is big money screaming, protect my yield. 2. Private credit is the shadow bank quietly feeding that hunger at 8 to 14% returns. 3. Your job is to know where your safe income actually lives before the music stops. Subscribe, come back tomorrow, and stop letting other people profit from the loans written in your name. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.